There is a promise that whispers through the corridors of finance, a secret hiding in plain sight within the most read financial documents in the world. It's a promise made not in words but in numbers, not in quarterly guidance but in the relentless upward march of a company's intrinsic value over decades. This is the final promise of investing. It's not about a dividend check arriving in the mail, a temporary comfort in a world of uncertainty. It's not about the thrill of a stock tip that doubles in a week, a flash of speculative lightning. The final promise is something deeper, more powerful, and infinitely more enriching. It is the promise of partnership with a machine that runs not on oil or electricity but on capital, a machine that takes every dollar of profit it generates and, through a kind of financial alchemy, transforms it into more than $1 of genuine, durable market value. This is a compounding machine, and finding just a handful of them over a lifetime is the sole difference between a life of financial anxiety and one of true, lasting financial freedom. It is the engine of generational wealth. Most investors, however, will never find one. They spend their lives searching in the wrong places, guided by a map that leads them astray. They are told to hunt for income, to chase high dividend yields, believing that a company sharing its profits is a sign of strength and stability. They buy the utility company paying a 5% dividend, the sleepy consumer brand paying out 4%, and they feel safe. They see the cash hit their account and mistake it for a victory. But what they don't see is the opportunity cost, the silent theft of their future. They are collecting pennies from a business that is slowly, quietly dying, while right next door another business is retaining every penny it earns, planting them in fertile soil and growing a forest of future profits. The dividend check is a lullaby, singing the investor to sleep while their capital stagnates. This is the great dividend delusion, the idea that getting paid can make you richer, when in fact, for the long-term investor, it can be the very thing that makes you poor. Today, we shatter that delusion. We will discard the flawed map and give you the compass used by the greatest capital allocator of all time, Warren Buffett. This isn't about complex formulas or insider information. It is about a fundamental shift in perspective. It's about learning to see a business not as a stock chart wiggling on a screen, but as a living entity with a single critical task: to allocate the capital it generates. The journey we are about to embark on will deconstruct this profound idea into its core components. We will begin by understanding the single most important decision any CEO makes, the one that separates the wealth creators from the wealth destroyers. We will then confront the psychological traps that lure millions into the false comfort of dividends. We will build, from the ground up, a detailed blueprint for identifying the anatomical features of a true compounding machine. We will learn to read financial statements not as an accountant would, but as a business owner would, calculating the true, hidden earning power of a company. And finally, we will confront the most difficult challenge of all: the discipline of patience, the quiet courage required to let these machines do their work over the years and decades required to build fortunes. This is the master key to unlocking exponential portfolio growth, the strategy for not just participating in the market, but for decisively beating the market over the long run. This is the path to real wealth management, the kind you perform yourself, for yourself. This is the final promise. The story of modern investing, the story of how fortunes are truly built, cannot be told without understanding a single, overarching principle that eclipses almost all others. It's a concept that is rarely discussed on financial news networks and is often buried in the footnotes of business school textbooks. It is the principle of capital allocation. For the retail investor, for the serious student of business, and even for entrepreneurs running their own companies, grasping this concept is like being handed a key to a locked room filled with treasure. To understand its power, we must first understand that a business, at its core, is a system for converting capital into profit. It takes in money, builds factories, hires people, creates products, and generates cash. After all the bills are paid, a pool of profit remains. At this moment, the company's leadership, the CEO, faces a handful of choices. What do they do with this cash? This single question is the most important determinant of your long-term returns as an investor. The CEO can, broadly speaking, do 5 things. They can reinvest it back into the business, funding new projects, expanding operations, what we call capital expenditures. They can acquire other businesses, they can pay down debt, they can return the money to shareholders by buying back stock. Or they can return the money to shareholders by paying a dividend. That's it. Those are the choices. The skill with which a CEO navigates these 5 options, year after year, is the skill of capital allocation. And according to Warren Buffett, it is the most vital, yet most underrated, skill in business. The secret he unlocked decades ago was that it is far more valuable to invest in a mediocre business run by a brilliant capital allocator than it is to invest in a brilliant business run by a mediocre one, because the brilliant allocator will, over time, steer the ship away from the mediocre business and into more profitable waters. To see this principle in action, we must travel back to the 1960s and look not at Buffett himself, but at the man he considered the greatest manager in American history, a man named Tom Murphy. Murphy ran a tiny, obscure company called Capital Cities Broadcasting. It started with a single bankrupt television station in Albany, New York. Tom Murphy was not a media visionary in the traditional sense. He wasn't a charismatic programmer or a hard-nosed journalist. He was a capital allocator of breathtaking genius. His playbook was simple but devastatingly effective. He would buy media properties, television stations, radio stations, newspapers that were undermanaged and inefficient. He would install ruthless cost controls, delegate operational authority to talented local managers, and turn these assets into fountains of cash. But here is the crucial step, the one that separates the good from the legendary. Murphy did not then use this cash to build a lavish corporate headquarters or to pay himself an obscene salary. He didn't even pay a significant dividend. Instead, he took every dollar of profit and went looking for the next undervalued media property to buy. He was a human compounding machine. He treated the shareholders' money as his own, with a fiduciary duty that was absolute. He understood that a dollar retained inside the company had to generate at least a dollar of market value for his shareholders. If it couldn't, he would have given it back. But he was so good at finding new, profitable places to deploy that capital that giving it back would have been a disservice to his investors. Buffett watched Murphy for years, marveling at his discipline. He saw a manager who thought not like a media executive, but like an investor. In his 1986 letter to Berkshire Hathaway shareholders, Buffett laid it all out. He compared the track record of Tom Murphy to other star CEOs of the era. From 1966 to 1986, the 20 years leading up to one of the biggest deals in corporate history, Capital Cities, under Murphy's leadership, achieved a staggering 20.4% compounded annual return on its equity. The S&P 500 over that same period returned just 6.1%. This wasn't just beating the market, it was a wholesale demolition of it. And it was achieved not through some revolutionary technology, but through the relentless, intelligent, decade-after-decade reinvestment of capital at high rates of return. The culmination of this masterclass in capital allocation came in 1985. Tom Murphy, the operator of a once tiny broadcasting company, announced he was acquiring a giant, the American Broadcasting Company, or ABC. It was a deal that stunned Wall Street. Capital Cities was acquiring a company 4 times its size. It was a minnow swallowing a whale. The deal was valued at $3.5 billion, an astronomical sum at the time. To finance it, Murphy needed a partner with deep pockets and a shared philosophy. He called the one man he knew would understand the logic of the deal instantly, Warren Buffett. Buffett, through Berkshire Hathaway, invested $517 million to help finance the acquisition. He didn't do it because he was an expert in television programming schedules. He did it because he was betting on the capital allocator, Tom Murphy. He knew Murphy would apply the same ruthless efficiency and intelligent reinvestment strategy to ABC that he had applied to every other asset he had ever purchased. And he was right. The combined company, Capital Cities/ABC, became a powerhouse of profitability. The acquisition was a stunning success, validating every principle Murphy had practiced for decades. For Buffett, his investment was not just a financial windfall, it was the ultimate proof of his thesis. The skill of the person allocating the capital is the ultimate determinant of shareholder returns. Finding a manager like Tom Murphy, who combines integrity with a genius for reinvestment, is the holy grail of long-term investing. The reason this powerful concept remains a secret to so many is rooted deep in human psychology. At the heart of it is a conflict known in economics as the agency problem, or the, quote, principal-agent dilemma. In the world of public companies, the shareholders are the owners, the principals. The CEO and the management team are the agents hired to act in the principal's best interests. The problem is that the agent's interests often diverge from the principal's. A shareholder, the principal, wants one thing above all else: an increase in the long-term, per-share intrinsic value of the business. That's what makes them richer. But what does the CEO, the agent, want? Often, their incentives are tied to other things. They might want power, prestige, and public acclaim. This often translates into a desire to run a larger company, not necessarily a more profitable one. They want to be on the cover of Fortune magazine, heralded as a visionary empire builder. They are incentivized by the size of the empire they command, not the per-share value they create for the owners. This psychological divergence leads to predictably terrible capital allocation decisions. The empire-building CEO is addicted to activity. They feel pressure to do something, with the cash piling up on the balance sheet. Instead of patiently waiting for a truly great opportunity, or admitting they have no great ideas and returning the cash to shareholders, they chase growth for growth's sake. They make splashy, overpriced acquisitions in unrelated fields, diversifying for the sake of diversification, a phenomenon Buffett calls diversification. They overpay massively, driven by ego and the desire to win a bidding war. The investment bankers, who get paid for doing deals, not for their long-term success, cheer them on. The financial press celebrates the bold move. But for the shareholder, the owner, it is often a catastrophe. The value of their ownership is diluted and destroyed. Buffett's entire philosophy is designed as an antidote to this agency problem. He looks for CEOs who think like principals, not agents. He wants a manager whose primary goal is the same as his, to increase the per-share value of the business. A great capital allocator has the discipline to do nothing when there is nothing to do. They have the humility to admit when opportunities within the business are scarce, and the integrity to return the money to shareholders, either through intelligent buybacks or dividends, when they can't find a better use for it. They are allergic to bureaucracy and corporate waste. They run the business as if it were their own family's only asset, because in their mind it is. So how can you, as a retail investor, apply this profound lesson in your own stock picking? How can you separate the Tom Murphys from the value-destroying empire builders? You can develop a mental model, a practical blueprint I call the CEO scorecard. This is not about judging a CEO's charisma on television interviews. It's a forensic analysis of their decisions. Step 1. Become a financial historian. Pull up the company's annual reports and cash flow statements for the last 10 years. Your goal is to trace the flow of cash. Where did the company's profits go? How much was spent on capital expenditures to maintain and grow the business? How much was spent on acquisitions? How much on share buybacks? How much on dividends? How much was used to pay down debt? You are creating a decade-long map of their capital allocation decisions. Step 2. Judge the results of those decisions. This requires some work. For acquisitions, did they actually add to the company's per-share earning power, or were they expensive failures? Look at the return on invested capital, ROIC, of the company before and after the big deals. If ROIC went down significantly, the acquisition likely destroyed value. For share buybacks, were they done at intelligent prices? A company buying back its stock when it's absurdly overvalued is just wasting shareholder money. A company buying back its stock when it's trading below its intrinsic value is creating immense value for the remaining shareholders. You must judge the price at which they bought. For capital expenditures, did the investments in new plants or technology lead to higher profits and returns, or was it just money spent to tread water in a competitive industry? Step 3. Read the CEO's annual letter to shareholders. This is a window into their mind. Do they speak with clarity and candor about the business's results, both good and bad? Do they explicitly discuss capital allocation and the returns they expect from their investments? Or is the letter filled with corporate jargon, meaningless buzzwords, and self-congratulation, blaming bad results on external factors? A great CEO, like a great teacher, makes the complex simple. A poor CEO often makes the simple complex. Compare what they said they would do in past letters with what they actually did. Step 4. Synthesize your findings. Based on their 10-year track record of decisions and the clarity of their thinking, does this CEO act more like an owner or more like a hired hand? Are they a masterful capital allocator or a frustrated empire builder? This scorecard, this mental model, transforms your approach from passive speculation to active business analysis. It is the first and most critical filter in your quest for compounding machines. The tragedy is that the vast majority of investors, the 99%, do the exact opposite. They follow the path of the empire builder. They are drawn to the spectacle of big, exciting deals. They confuse growth in revenue with the creation of value. A company announces a multi-billion-dollar acquisition, and the stock price often jumps. Investors pile in, excited by the headlines, believing that bigger is always better. They are participating in a collective delusion, cheering on the very actions that are most likely to harm their long-term returns. The poster child for this folly is the disastrous AOL-Time Warner merger in 2000. At the peak of the dot-com bubble, AOL, the high-flying internet company, acquired Time Warner, the old media stalwart. It was hailed as a visionary fusion of the new and old economies. The CEO of AOL, Steve Case, became a corporate icon, but it was an act of capital allocation hubris on an epic scale. The strategic synergies never materialized. The cultures clashed, and the price paid was astronomical. Within a few years, the company had to take a goodwill write-down of nearly $100 billion, one of the largest in corporate history, effectively admitting it had incinerated a fortune. Investors who cheered the deal and bought at the top were wiped out. They were victims of an empire builder's CEO who chose growth and glory over the rational allocation of shareholder capital. This pattern repeats itself in every market cycle. The names change, but the behavior is the same. The 99% chase the story, the grand vision, the charismatic CEO. The disciplined investor ignores the noise and focuses on the quiet, unglamorous, but ultimately decisive skill of capital allocation. The direct financial connection of this principle is profound and can be seen clearly on a company's financial statements if you know where to look. Great capital allocation directly translates into a consistently high and/or rising return on invested capital, or ROIC. ROIC measures how much profit a company generates for every dollar of capital invested in the business. A master allocator like Tom Murphy constantly seeks to deploy cash into projects or acquisitions that generate returns far above the company's cost of capital. This drives the company's overall ROIC higher. A poor allocator, the empire builder, makes acquisitions that generate low returns, depressing the company's ROIC. Over time, the difference is staggering. A company that can consistently generate a 20% ROIC will create vastly more wealth for its shareholders than one that generates an 8% ROIC. Furthermore, a great allocator creates value that manifests as a rapid increase in book value per share. When a company retains its earnings and reinvests them wisely, its asset base grows without a corresponding increase in the number of shares outstanding. This means each individual share now lays claim to a larger piece of the business. Buffett has often said that his primary goal for Berkshire Hathaway is to increase its per-share book value over time. knowing that if he does, the market price will eventually follow. In contrast, a poor allocator might grow the overall size of the company, but they often do so by issuing tons of new stock to fund acquisitions, or by taking on massive amounts of debt. The result is that even if the company gets bigger, your individual slice of the pie, your per-share value, can stagnate or even shrink. By focusing on the CEO's capital allocation skill, you are aligning yourself with the fundamental driver of long-term, per-share value creation, a force far more powerful and predictable than the daily whims of the stock market. There exists a pervasive and deeply comforting myth within the world of investing. It's a story told to retirees, to conservative investors, to anyone seeking a sense of safety and predictability in the chaotic theater of the market. This is the dividend investing myth. The story goes like this. Find good, stable companies that pay a consistent and growing dividend. The dividend check is your reward, a tangible return on your investment, real cash in your pocket. It provides a steady stream of income, and the company's commitment to paying it is a sign of financial health and shareholder friendliness. On the surface, it sounds prudent, sensible, and safe. But it is one of the most insidious and costly delusions in personal finance. For the investor seeking not just income, but true, long-term portfolio growth, an obsession with dividends can be a powerful anchor, weighing down your returns and, in real terms, making you poorer over time. The thumbnail of this video says dividends can make you poor. That is not hyperbole. It is a mathematical and economic reality for those who fail to look beyond the immediate comfort of a cash payment. The most powerful illustration of the philosophy that opposes this myth is the very company that Warren Buffett built. Berkshire Hathaway, one of the largest and most successful corporations in the world, a company that has created more wealth for its shareholders than perhaps any other in history, has not paid a dividend since 1967. Let that sink in. For over half a century, a company that generates tens of billions of dollars in profit every single year has deliberately chosen to return not 1 cent of it to its owners in the form of a dividend. Why? Because Warren Buffett made a simple, standing promise to his shareholders, his partners. That promise is this: for every dollar of profit that Berkshire Hathaway retains, he believes he can convert it into more than $1 of long-term market value for the company. So if he were to pay you a $1 dividend, he would be taking away your dollar and his ability to turn it into, say, $1.10 or $1.20 of real value for you. A dividend in this context is an admission of failure. It is a signal from management that they have run out of profitable ideas. It is them saying, we have no way to invest this dollar for you at a high rate of return, so here, you take it back and try to do it yourself. For decades, in his annual letters, Buffett has rigorously defended this position with cold, hard numbers. He treats retained earnings as a test. If a company retains $1 of earnings, its market value should, over time, increase by at least that dollar. If it doesn't, management has failed the test. Let's look at the record. From 1965 to 2022, the per-share market value of Berkshire Hathaway has compounded at an astonishing 19.8% annually. The S&P 500, with all its dividends reinvested, compounded at 9.9%. The gap is monumental. A single $1,000 invested in Berkshire in 1965 would be worth tens of millions today. That same $1,000 in the S&P 500 would be a respectable sum, but a tiny fraction of the Berkshire result. The source of this Grand Canyon-sized gap in performance is capital allocation. It is Buffett's ability, year after year, to take the retained earnings from Berkshire's operating businesses, like See's Candies and the Nebraska Furniture Mart, and redeploy them into other wonderful businesses and investments, compounding the capital internally at a rate far higher than the average company could achieve. Had he paid out those profits as dividends, his shareholders would have received the cash, paid taxes on it, and then been faced with the difficult task of finding a new investment that was as good as the one their money was just taken out of, Berkshire Hathaway itself. The Berkshire story is the ultimate foundational anecdote. It is a living, 50-year-long testament to the idea that for a truly great business, with a great allocator at the helm, the single worst thing management could do is pay a dividend. The powerful allure of the dividend myth is not based on financial logic, but on deep-seated psychological biases. The first and most potent of these is a cognitive shortcut called mental accounting. Our brains don't treat all money as equal. We create separate, invisible buckets in our minds. There's salary money, vacation money, emergency money. And for investors, there are two very important buckets: capital and income. The stock itself, the principal you invested, sits in the capital bucket. The dividend check that arrives is mentally categorized as income. This is a critical distinction. We feel good about spending income. It feels like a free reward, a surplus. But we are intensely reluctant to touch our capital. Selling a stock to generate cash feels like a failure, like dipping into our core savings. This is amplified by another powerful bias: loss aversion. Studies by psychologists like Daniel Kahneman and Amos Tversky have shown that the pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. If you need cash, and your high-dividend stock is down 10%, you are psychologically paralyzed. Selling it would mean realizing the loss, an act that is intensely painful, but the dividend check? That feels separate. It arrives no matter what the stock price is doing. It's safe income, divorced from the painful fluctuations of the capital bucket. Dividend-paying companies exploit this bias perfectly. They provide a steady drip of psychological comfort, a pacifier for the anxious investor. This allows investors to hold on to stocks of stagnant, no-growth companies for years, feeling good about their income, while their total wealth is being decimated by inflation and a flatlining stock price. They are winning the mental accounting battle but losing the war for financial freedom. To break free from this psychological trap, you need a new mental model. You must adopt what I call the total return framework. It forces you to erase the artificial line between capital and income and see your investments for what they are: a single, unified pool of wealth. Here's how you apply it. Step 1. Completely ignore the dividend yield of a stock in isolation. It is one of the most misleading metrics in finance. Instead, your focus must be on the company's estimated total return, which is the combination of its earnings growth and its dividend yield. A company with 15% annual growth and no dividend is vastly superior to a company with 1% growth and a 5% dividend. Step 2. Ask the single most important question that Buffett asks: what is the company's return on retained earnings? For every dollar that the company does not times pay you as a dividend, how much durable market value is it creating for you? A great company can retain $1 and create $1.50 in value. A poor one retains $1 and creates 80 cents of value, actively destroying your capital. You can estimate this by looking at the increase in book value per share plus the dividends paid, divided by the net income of the previous year. A high number indicates a powerful, internal compounding engine. Step 3. Analyze the payout ratio. The payout ratio is simply the percentage of a company's earnings that are paid out as dividends. A very high payout ratio, say over 70% or 80%, is often a massive red flag. It tells you that the company's management has no better ideas. Their business is mature, stagnant, and has no attractive opportunities for reinvestment. They are effectively liquidating the company, slowly, and sending the proceeds to you. This is not a growth investment. It's a glorified savings account with stock market risk. Step 4. Learn to create a homemade dividend. If you genuinely need income to live on, you are far better off owning a portfolio of superior, non-dividend paying growth companies and periodically selling a small fraction of your holdings. This forces you to engage with the total return framework. It shatters the mental accounting buckets. You will sell a small piece of your best performer, a rational act of harvesting profits, rather than clinging to a portfolio of stagnant businesses just because they mail you a check. This approach gives you control and forces you to think like a true business owner, not a passive income collector. The antithesis of this framework, the path walked by the 99%, is the yield chaser. We all know this person. Often, they are nearing or in retirement, gripped by the fear of outliving their money. They've been told by conventional financial advisors that the key to a safe retirement is to shift their portfolio from growth stocks to income-producing assets. So they load up on stocks with the highest possible dividend yields. They buy the telecommunications giant with a 7% yield, ignoring that its business is shrinking under competitive pressure and it's saddled with debt. They buy the regional utility with a 5% yield, ignoring that its growth is capped by regulators and its infrastructure requires constant, costly upgrades. They buy the real estate investment trust with an 8% yield, ignoring that its portfolio of B-grade shopping malls is being rendered obsolete by e-commerce. The yield chaser feels smart. They've locked in their income. But what is really happening? They collect their 6% average dividend, on which they pay income tax. Meanwhile, inflation is running at 3 or 4%, eroding the purchasing power of that income. And worse, the underlying value of their stocks, their capital, is flat or slowly declining because these businesses have no growth prospects. 10 years later, their income stream buys less than it used to, and their nest egg has not grown at all. They are running on a financial treadmill, working hard just to stay in the same place, slowly getting poorer in real terms. They have fallen for the dividend delusion, and the price is their long-term financial security. The direct financial connection here is stark and undeniable, and it comes down to one of the most powerful forces in the universe: taxes. The Modigliani-Miller theorem on dividend irrelevance suggests that in a world with no taxes and no transaction costs, it makes no difference to a shareholder's wealth whether a company pays a dividend or retains the earnings and allows the share price to rise. The shareholder ends up with the same total return. But we do not live in that theoretical world. We live in a world with taxes, and this completely changes the game. When a company pays you a dividend, that income is taxed for the year it has received. You have no choice. The government takes its cut immediately, reducing the amount of capital you have available to reinvest. Now consider the alternative. A company retains that dollar of earnings and reinvests it, causing the stock price to increase by $1. You have a capital gain. But here's the magic. You do not pay any tax on that gain until the day you decide to sell the stock. This allows your entire, untaxed investment to continue compounding year after year. It's like having an interest-free loan from the government. The longer you hold the stock, the more powerful this tax-deferred compounding becomes. Over a 20, 30, or 40-year investing lifetime, the difference in ending wealth between a portfolio that is constantly taxed on its dividends and a portfolio that allows capital gains to compound untaxed for decades is not just significant, it is astronomical. It is the difference between a comfortable retirement and true generational wealth. The dividend investing myth isn't just a flawed strategy, it's a tax-inefficient one that creates a permanent headwind against your long-term goals. By shifting your focus from dividend income to tax-deferred capital gains, you are making a direct, quantifiable decision to harness the power of compounding in its purest and most potent form. Once we accept the supremacy of capital allocation and reject the dividend delusion, our mission as investors becomes crystal clear. We must find the compounding machines. These are the rare and extraordinary businesses that can take their own profits, their retained earnings, and reinvest them at sustainably high rates of return for very long periods of time. These are the engines of wealth creation. An investment in one of these companies is not a passive bet on a stock ticker. It is an active partnership with a superior economic engine. Your capital is not just sitting there. It is being put to work by skilled management, creating more value on your behalf year after year. Owning a piece of a compounding machine is like owning a goose that lays golden eggs and then uses those golden eggs to hatch more golden egg-laying geese. The process is exponential. But these businesses are not easy to find. They have specific, identifiable characteristics, an anatomy that you must learn to recognize. Understanding this anatomy is the most crucial skill in the entire discipline of long-term investing. Perhaps the most instructive story of identifying and purchasing a compounding machine is one that, on the surface, seems incredibly boring. It has none of the glamour of technology or biotech. It's the story of See's Candies. In 1972, Warren Buffett and his partner Charlie Munger, through their company Blue Chip Stamps, purchased See's Candies for $25 million. See's was a well-known, family-owned chocolate company based in California. By any conventional measure of the day, Buffett overpaid. He paid a price that was significantly above the company's tangible assets, its book value. The Wall Street value investors of the era would have scoffed at the purchase. They were trained to buy businesses for less than the liquidation value of their factories and inventory. But Buffett and Munger saw something else. They saw a business with a powerful, albeit intangible, asset, a deep and abiding brand loyalty in the minds of its customers. People in California didn't just buy See's chocolates. They had an emotional connection to them. They were a part of birthdays, holidays, and family traditions. This emotional connection gave See's a durable competitive advantage, what Buffett would later popularize as a moat. This moat gave See's something extraordinary: pricing power. Every year, they could raise the price of their chocolates by a little bit, and their customers wouldn't even think of switching to a cheaper brand. The price increase would flow almost entirely to the bottom line as pure profit. But here is the second and equally critical piece of the compounding machine anatomy. The business of making and selling chocolates did not require massive amounts of capital to grow. They didn't need to build billion-dollar factories or spend fortunes on research and development. Growth came from opening a few new stores and from those modest price increases. The result was a business that produced far more cash than it needed to maintain or expand its operations. See's Candies became a gusher of free cash. Since its purchase for $25 million, See's has sent more than $2 billion in pre-tax profits up to its parent company, Berkshire Hathaway. That $2 billion was cash that didn't need to be reinvested in the candy business. It was capital that Buffett could then allocate to other incredible investments, like Coca-Cola, American Express, or Apple. See's was the prototype. It taught Buffett and Munger that it's far better to buy a wonderful business at a fair price than a fair business at a wonderful price. It was a machine that required very little capital to run, but produced enormous amounts of capital for its owners to deploy elsewhere. That is the essence of a great compounding machine. The explosive power of a business like See's Candies is difficult for our brains to fully appreciate because it is the result of what Charlie Munger calls the Lollapalooza effect. This is the psychological principle that when several powerful factors are all working together in the same direction, the result is not additive but multiplicative. It's a non-linear outcome. Our brains have evolved to think in a linear fashion. We expect that if we put in 2 units of effort, we get 2 units of result. If we put in 4 units of effort, we get 4 units of result. But a true compounding machine defies this intuition. It's not just one thing that makes it great. It's the combination of a wide, durable moat, which allows for high returns on capital. That high return on capital generates a flood of cash. That cash is then reinvested by skilled management into more high-return opportunities. And this virtuous cycle is protected by a long runway for growth. When you get all 4 of those factors, a deep moat, high returns, skilled management, and a long runway working together, the result is not linear growth. It is exponential, explosive growth. The Lollapalooza effect kicks in, and the value of the business starts to curve upwards in a way that feels almost magical. Our inability to intuitively grasp the power of exponential functions is one of the biggest psychological hurdles to successful long-term investing. We see a stock that has gone up for 5 years and we think it can't possibly keep going. We sell too early, cutting our flowers and watering our weeds, because we cannot comprehend the sheer mathematical force of a true Lollapalooza effect in action. To systematically identify these rare businesses, you need a mental model, a checklist that acts as a filter to sift through the thousands of publicly traded companies. I call it the compounding machine checklist. It consists of 5 critical questions. Question 1. Does the business have a deep and durable competitive moat? A moat is a structural advantage that protects a company from competition, just as a moat protects a castle. There are 4 main types. Brand, like See's Candies or Coca-Cola. Network effects, where the service becomes more valuable as more people use it, like Visa or Facebook. High switching costs, where it is a pain for customers to move to a competitor, like the bank you've used for 20 years or the enterprise software your company runs on. And being the low-cost producer, like Costco or Geico. You must identify the moat and, more importantly, make a judgment about whether that moat is getting wider or narrower over time. Question 2. Does the company consistently generate a high return on capital? The key metric here is return on invested capital, or ROIC. This measures how effectively a company is using its money to generate profits. You want to see companies that consistently generate an ROIC of 15% or higher. A high ROIC is the financial signature of a great moat. It's proof that the company has a special something that allows it to earn outsized profits. Question 3. Does the company have a long runway for growth? This is crucial. A wonderful business with a great moat and high returns that has nowhere to expand is what's called a cash cow. It's a good investment, but it's not a compounder. A true compounding machine needs opportunities to reinvest its flood of cash at those same high rates of return. This could be expanding into new geographic markets, introducing new product lines, or making small, bolt-on acquisitions. You must assess the size of the company's total addressable market. Question 4. Is the management team honest and talented, with a demonstrated skill for capital allocation? This brings us back to our first pillar. You need a Tom Murphy at the helm, a jockey who understands their job is to increase per-share value. You must analyze their track record, not listen to their promises. Question 5. Is the stock available at a reasonable price? Even the greatest business in the world can be a terrible investment if you overpay for it. You don't need to buy it at a dirt-cheap price, but you must buy it at a price that allows for a satisfactory future return. Answering these 5 questions with diligence and intellectual honesty is the practical, step-by-step blueprint for finding the next great compounding machine. The antithesis of the compounding machine is a common and dangerous trap for investors, the growth trap. These are companies that are growing, sometimes very rapidly, but in a way that creates no value for shareholders. The classic example is the airline industry. Airlines are constantly growing. They buy new planes, add new routes, and carry more passengers. Their revenues go up, but the industry is brutally competitive. There are no durable moats. A new competitor can easily enter a route and cut prices. The business is also incredibly capital-intensive. Those new airplanes cost hundreds of millions of dollars. The maintenance, the fuel, the labor, it all consumes vast amounts of cash. The result is a business that has to pour every single dollar it earns, and then borrow billions more, right back into the business just to stay competitive. They grow, but they never generate any free cash for their owners. Their return on invested capital is chronically low, often below their cost of capital, meaning they are actively destroying value with every new dollar they invest. Investors get seduced by the top-line growth. They see passenger numbers increasing and they think it must be a good investment, but they fail to see the economic reality underneath. They have fallen into the growth trap, a business that mistakes activity for progress and revenue for profit. A compounding machine, like See's Candies, requires very little capital and generates a ton of it. A growth trap company, like many airlines, requires a ton of capital and generates very little. The difference is the chasm between wealth creation and wealth destruction. The direct financial connection between finding a compounding machine and building wealth lies in the simple but profound mathematics of ROIC. The rate at which a company can grow its intrinsic value is, over the long run, inextricably linked to its return on invested capital. Imagine 2 companies, Company A and Company B. Both start with an invested capital of $100 million, and both decide to reinvest all of their profits back into the business. Company A is a true compounding machine with a durable moat, and it consistently generates a 20% return on its invested capital. Company B is a more average business in a competitive industry, and it generates an 8% return on its invested capital. In year 1, Company A earns $20 million in profit and reinvests it. Its invested capital base is now $120 million. Company B earns $8 million and reinvests it. Its capital base is now $108 million. The gap seems small, but let's let the machine run. After 10 years, Company A's invested capital will have grown to over $619 million. Company B's will be just $215 million. After 20 years, Company A's capital base explodes to over $3.8 billion. Company B's is a respectable but paltry by comparison, $466 million. After 30 years, Company A is worth an almost unbelievable $23.7 billion. Company B is worth just over $1 billion. The paths have diverged to an almost comical degree. This is not a stock market fantasy, this is the underlying economic reality. A company's ROIC acts as the speed limit for its ability to compound value. By focusing your search on those rare businesses with sustainably high ROIC, you are tilting the mathematical laws of finance decisively in your favor. You are choosing to partner with the exponential curve, the most powerful force for wealth creation that has ever existed. To truly master the art of identifying these compounding machines, we must go deeper than the standard financial statements. We must learn to see a business through the eyes of Warren Buffett, to calculate its true earning power in a way that cuts through the fog of accounting conventions. Public companies report their earnings according to Generally Accepted Accounting Principles, or GAAP. But Buffett realized long ago that GAAP earnings often paint a misleading picture of a company's real economic condition. He developed his own metric, a more honest measure of profitability that he called owner earnings. Understanding how to calculate and use owner earnings is like having a pair of X-ray glasses. It allows you to see the real cash-generating skeleton of a business, stripped of the accounting fat and muscle that can obscure the truth. For any serious investor committed to long-term investing, this concept is not optional, it is essential. A fantastic story that illustrates Buffett's focus on the underlying economic reality over reported figures is his purchase of the Buffalo Evening News in 1977. On the surface, it looked like a terrible investment. The newspaper industry was already seen as being in structural decline. The city of Buffalo was suffering from economic hardship. The newspaper had a competing morning paper, and it was losing money. The GAAP income statement was a sea of red ink. Most investors, looking at the reported numbers, would have run for the hills. But Buffett did what he always does. He ignored the reported earnings and dug into the fundamental business economics to figure out the true owner earnings. He saw that the Buffalo Evening News was the dominant evening paper and had a Sunday edition, which was highly profitable. Its competitor, the morning paper, was weak and was also losing money. Buffett reasoned that in a two-paper town, the situation was often a race to the bottom, but if one paper were to close, the survivor would inherit a highly profitable local monopoly. He calculated that the combined entity, as a single newspaper in the city, would have immense pricing power with advertisers and would require very little in additional capital expenditures to operate. In other words, the potential owner earnings of a monopoly newspaper in Buffalo were enormous, even if the current GAAP earnings were negative. He was betting on the future cash flow, not the past accounting results. Berkshire bought the paper for $32.5 million. Shortly after, the morning paper did indeed close down, and the Buffalo Evening News became exactly what Buffett had envisioned. A cash-generating machine that for years produced owner earnings far in excess of what it needed for reinvestment, sending a river of cash back to Omaha for Buffett to allocate. This anecdote reveals the power of the owner earnings concept. It allows you to see value where others see only losses, by focusing on what a private owner could truly extract from the business over the long term. The reason most investors fail to do this kind of analysis is, once again, rooted in a powerful cognitive bias. This time, it's the anchoring and adjustment bias. Our brains are lazy. When we're asked to estimate a number, we tend to grab onto the first piece of information we're given, the anchor, and then we adjust our estimate up or down from there. But our adjustments are almost always insufficient. In investing, the most prominent anchor in the entire financial world is the quarterly earnings per share, or EPS number. It's the headline figure in every earnings report. It's what the Wall Street analysts build their models around. It's the number that determines whether a stock beats or misses expectations. The average investor anchors on this reported EPS number. They see a company that earned $2 per share and they think, okay, this is a $2 per share earning business. Their entire valuation process is anchored to that GAAP figure. Buffett's genius is that he systematically disregards this anchor. He knows it's often a fiction. He starts from a different place entirely. He builds his estimate of earnings from the ground up, based on the cash that flows in and out of the business. By refusing to anchor to the convenient but often flawed EPS number, he frees himself from the market's collective delusion and can make a more rational and often more profitable judgment about a company's true worth. So let's build the mental model. How do you, as a retail investor, calculate owner earnings? Buffett laid out the formula in his 1986 shareholder letter, and it's a blueprint for clear thinking. Step 1. Start with the company's reported net income. This is your baseline, the number from the income statement. Step 2. Add back all non-cash charges. The most common of these are depreciation and amortization. These are accounting expenses that are meant to represent the gradual wearing out of a company's assets, but they don't involve an actual cash outlay in the current year. So we add them back to get closer to the cash reality. Step 3. This is the most important and most difficult step. You must subtract the average annual amount of capital expenditures, or CapEx, that the business requires just to maintain its long-term competitive position and its unit volume. This is called maintenance CapEx. It's the money the company has to spend on replacing old factories and upgrading equipment simply to stay in the same place. This is not the CapEx spent on growth, only the amount needed to tread water. This number isn't listed on any financial statement. You have to estimate it. You can do this by looking at a decade of the company's CapEx spending. Talk to management if possible, or read their reports to see if they break out maintenance versus growth CapEx. A simple but often effective rule of thumb is that for many stable businesses, maintenance CapEx is often close to the annual depreciation charge. The result of this calculation, net income plus depreciation/amortization minus maintenance CapEx, is owner earnings. This is the real pot of gold. It's the amount of cash the business generates that is truly available to be distributed to the owners or to be used for growth initiatives. Step 4. Compare your owner earnings calculation to the reported net income. If owner earnings are significantly and consistently higher than net income, you may have found a hidden gem, a company that is far more profitable in cash terms than it appears on the surface. If owner earnings are consistently lower than net income, you've found a red flag, a company that looks profitable but is actually a capital-intensive beast that consumes all its own cash just to survive. The antithesis to this disciplined approach is the GAAP earnings obsessive. This is the typical investor, and even many professional analysts, who lives and dies by the quarterly EPS number. They build complex models that project EPS out to 2 decimal places, but they have no real concept of the underlying cash flow reality of the business. They are easily fooled by companies with aggressive accounting practices. For example, some companies can boost their reported net income by capitalizing costs that should be expensed. They might treat software development or marketing costs as an investment on the balance sheet, rather than an expense on the income statement. This makes their reported profits look much higher than their actual cash profits. The GAAP earnings obsessive sees the high EPS number and gets excited, buying the stock. The owner earnings analyst sees that the company's CapEx is massive and its cash flow is negative, and they stay far away. The ultimate example of this, of course, was Enron. Enron was a master at using accounting tricks to report incredibly smooth and rapidly growing earnings per share. Analysts loved them. They were a Wall Street darling. But it was all a house of cards. The company was not actually generating any cash. The owner earnings were deeply negative. The entire edifice was built on accounting fraud that an owner earnings-focused investor might have detected, or at least been highly suspicious of, long before the collapse that wiped out so many GAAP earnings obsessives. The direct financial connection of the owner earnings concept goes to the very heart of valuation. The intrinsic value of any business is the discounted value of the cash that can be taken out of it during its remaining life. The best estimate for this future cash is not reported net income, it is owner earnings. Therefore, to properly value a business, you must use owner earnings as the foundation of your analysis. Let's take two hypothetical companies. Company A and Company B both report net income of $1 billion. To the GAAP earnings obsessive, they might look similarly attractive. But let's dig deeper. Company A is a capital-light software business. Its maintenance capex is only $100 million a year. Its owner earnings are $900 million. Company B is a heavy manufacturing company. To keep its old plants running, its maintenance capex is a whopping $800 million a year. Its owner earnings are only $200 million. Even though they have the same reported profit, Company A is generating 4.5 times more cash for its owners than Company B. A rational investor would pay a much higher price for Company A. By using an owner earnings-based discounted cash flow (DCF) model instead of a simple price-to-earnings ratio, you get a much more realistic and conservative estimate of a company's intrinsic value. This discipline protects you from overpaying. It forces you to focus on the actual cash available to you, the owner. It is the most robust and intellectually honest method of valuation, and it is the final analytical tool you need to confidently identify and value the true compounding machines that create generational wealth. We have now traveled through the core architecture of Warren Buffett's philosophy. We have established the primacy of capital allocation, debunked the dividend myth, dissected the anatomy of a compounding machine, and learned to calculate its true earning power. We have, in effect, assembled a powerful engine for identifying the world's greatest businesses. But an engine, no matter how powerful, is useless without fuel and a destination. In long-term investing, the fuel is capital, and the destination is financial freedom. The final and perhaps most crucial component of this entire system is the one thing that connects the engine to the destination: the road itself. That road is time, and the skill required to travel it is patience. This is the final promise. Finding the compounding machine is only half the battle. The true fortunes are made by those who have the psychological fortitude to hold on, to sit still, and to let the unseen forces of exponential growth do their work over not just years, but decades. There is no better story to illustrate this final principle than Buffett's investment in the Washington Post Company. In 1973, the stock market was in the midst of a brutal bear market. The mood was pessimistic, fearful. The Washington Post, despite being a premier newspaper with a dominant franchise, saw its stock get hammered, along with everything else. The entire company was trading in the market for about $80 million. Buffett, having done his analysis, knew this was absurd. He calculated that the company's assets, its television stations and newspaper, were worth at least $400 million, perhaps as much as $500 million. It was a classic case of buying a dollar bill for 40 cents. So over the course of 1973, Berkshire Hathaway invested about $10.6 million to acquire a significant stake in the company. Now, finding the undervalued asset was the easy part. The hard part was what came next: holding on. Shortly after his purchase, the stock went down. He was losing money. The bear market dragged on. Lesser investors would have panicked, sold their shares, and concluded they had made a mistake. But Buffett had conviction. He wasn't investing in a stock ticker. He was investing in a business. He had deep faith in the company's durable moat, its position as the dominant source of news in the nation's capital, and in the integrity and talent of its leader, Katharine Graham. So he held through the recession of the mid-70s. He held through the high inflation of the late 70s. He held through the market boom of the 80s and the crash of 87. He held through the rise of cable news in the 90s. He held for over 3 decades. And what was the result of this extraordinary patience? By the time Berkshire sold most of its stake in 2014, that initial $10.6 million investment had grown to be worth over $1.2 billion. That is a return of more than 11,000%. The vast majority of that gain did not come in the first year, or even the first 5 years. It came from the slow, relentless, year-after-year compounding of the business's value. The Washington Post story is the ultimate testament to the final promise. It demonstrates that the greatest returns don't go to the most brilliant analyst or the fastest trader. They go to the investor who can combine sound business analysis with the emotional discipline to do nothing, to sit on their hands, and to let a wonderful business work its magic over a lifetime. Why is this simple act of holding on so impossibly difficult for most people? The enemy is a deep-seated cognitive flaw known as hyperbolic discounting, or more simply, present bias. Our brains are hardwired to want rewards now, not later. We have an inbuilt preference for immediate gratification over delayed gratification. It's an evolutionary hangover from a time when the future was uncertain, and it was more important to eat the berry in front of you than to wait for a larger meal that might never come. This bias explains why people struggle to save for retirement, why they choose the unhealthy snack over the long-term benefits of a good diet, and why they fail as investors. An investor with present bias would rather take a small, quick profit today than wait for a much larger, life-changing profit 10 years from now. The constant noise of the market preys on this weakness. The financial news screams about the next hot stock. Your brokerage account shows your stocks moving up and down every second, tempting you to act. The allure of doing something, of selling a winner to lock in a gain, or selling a loser to stop the pain, is almost irresistible. This is your ancient brain fighting against the logic of long-term compounding. Mastering the final promise of investing is not an intellectual challenge, it is an emotional one. It requires you to actively recognize and override this powerful primitive urge for immediate action. To win this internal battle, you need a mental model that forces a long-term perspective. The most powerful one Buffett ever shared is the 20-slot punch card. He told students to imagine that when they graduate, they are given a punch card with only 20 punch holes in it. Each time they make an investment decision in their entire life, they have to punch one of those holes. Once the 20 punches are used up, they can't make any more investments. What would this constraint do to your behavior? You would think incredibly carefully about every single decision. You wouldn't swing at every pitch. You would wait for the perfect, fat pitch. An outstanding business you understand well, run by people you trust, available at a sensible price. You would dismiss speculative fads and short-term trades as a waste of a precious punch. And when you finally found an opportunity that met your rigorous criteria, you would invest with real conviction, making it a meaningful portion of your portfolio. And you certainly wouldn't sell it a year later for a small gain, because that would mean wasting another punch to find its replacement. The 20-slot punch card mental model is a brilliant device for enforcing discipline. It shifts your mindset from that of a frenetic trader to that of a patient, long-term business owner. It is the psychological armor you need to combat the destructive temptations of present bias and market noise. The antithesis of the punch card investor is the Quotron machine junkie. The name is dated, but the behavior is timeless. Today, it would be the smartphone stock app junkie. This is the investor who is glued to the screen, watching every tick of the market. Their emotional state is a direct reflection of the red and green arrows on their screen. They react to everything: a news headline, an analyst's upgrade or downgrade, a rumor on a message board. Their portfolio is in a constant state of churn. They buy stocks that are going up because they have a fear of missing out. They sell stocks that are going down because they are consumed by loss aversion. They mistake activity for progress. They think that by constantly trading they are controlling their destiny. But what they are actually doing is playing a loser's game. They are racking up huge costs in commissions and, more importantly, in taxes from short-term capital gains. They never give any of their ideas the one thing required for real success: time. The Quotron junkie is always planting seeds but pulls them up every morning to see if they've grown yet, ensuring they never get a harvest. They are destined for a career of frustrating mediocre returns, forever chasing the market but never beating it. They have rejected the final promise in favor of the immediate and ultimately empty thrill of the game. The direct financial connection of this final pillar is the most beautiful and inspiring of all. It is the pure, unadulterated mathematics of the exponential curve. Let's use the rule of 72, a simple way to estimate how long it takes for an investment to double. You just divide 72 by the annual rate of return. If you earn a 10% annual return, your money doubles about every 7.2 years. But if, by using the principles we've discussed, you can build a portfolio of compounding machines that earns a 15% annual return, your money now doubles every 4.8 years. The difference seems small at first, but let's project this out over a 40-year career of saving and investing. Let's say you invest $10,000 a year. At a 10% return, after 40 years, you would have a very respectable $4.87 million. But at a 15% return, that same investment grows to an astonishing $17.79 million. The 5% difference in annual return results in nearly 4 times more wealth. And here is the most magical part of the exponential curve. Of that $17.79 million, over half of it, nearly $9 million, is created in the final 7 years of the 40-year period. That is the unseen force of compounding. It is a backloaded process. The real, life-altering gains come in the final decades, but only for those who have the patience and discipline to get there. This is the financial manifestation of the final promise. It's the reward for a lifetime of rational thinking, emotional control, and unwavering patience. It's how you move beyond simply earning a living and begin to build true, lasting generational wealth. It is the endpoint of a journey that begins with a simple shift in perspective, away from the noise of the market and toward the quiet, powerful hum of a true compounding machine. You have just invested a significant amount of your most valuable asset, your time, to fundamentally rewire your approach to building wealth. You now possess the blueprint for identifying the engines of generational wealth, the compounding machines that quietly turn profits into fortunes. You've learned to see past the seductive lullaby of dividends, to calculate a company's true earning power, and to understand that the greatest returns are reserved for the patient. This is not just information. It is a complete mental toolkit, a weapon against the market's irrationality and your own worst psychological impulses. You have acquired the framework that has been the bedrock of one of the greatest financial successes in history. But identifying the engine is only the first step. A powerful engine in the wrong vehicle goes nowhere. A Formula One engine dropped into a station wagon will tear the chassis apart. Warren Buffett's true genius wasn't just in finding these individual companies, but in constructing the portfolio, the vehicle, that could carry this power across decades, through recessions, crashes, and manias. The structure matters. The way these individual machines are linked together, the principles of concentration versus diversification, the methods for managing risk without sacrificing returns, this is the second, equally critical, layer of the entire system. The next piece of the map, the video that is now on your screen, is not just another idea, it is the architectural plan for that vehicle. It reveals the principles of portfolio construction that connect these individual compounding machines into an unbreakable fortress of wealth. It's the bridge from knowing what to buy to knowing how to own. It explains the counterintuitive logic behind why holding fewer, better businesses can actually be safer than holding hundreds of mediocre ones. It is the link that connects everything you have just learned into a single, cohesive, and actionable strategy. You have proven that you are not a passive observer. You are an architect of your own financial future. The casual investor, the tourist, stops here, content with the blueprint for a single engine. They have a powerful component, but no plan to put it to use. The master builder, however, seeks the complete design. They understand that the engine is worthless without the right chassis, the right transmission, the right structure to harness its power. The choice you make in the next 5 seconds is a statement about which one you are. Click the video on your screen and continue the work of your ascent. Complete your mental arsenal. Become the master builder.